We're going to kick off our day with a thought-provoking discussion. Our first panel is about ensuring the energy transition with insurance. The role of risk transfer solutions in bridging the gap from equity to debt for climate projects. So please give a warm welcome to our first panel, Kobi Weinberg, Senior Manager of Strategic Initiatives at CREO. Stephan Lesser, Senior Underwriter, Green Tech Solutions Team Munich. Tyler Christie, Managing Director at the Decarbonization Partners. Matilda Elfving, Director at Altor Equity Partners. And moderating this interesting panel, many thanks to Dr. Amaya López-Durán Viani, Head of Industry Observatory at the BBVA. The stage is all yours. Thank you very much. A round of applause, please.
So, good morning to everybody. I hope you had a good evening yesterday and enjoyed the dinner at the Guggenheim Museum. I also hope your coffee this morning was strong and that you're ready to hear a fascinating panel about insurance. Yes, insurance. So, but first of all, let me introduce you to the panelists. So, ladies first. Allow me to introduce Matilda Elfving, a seasoned director at Altor Equity Partners. Her extensive experience at investment across the customer and tech sectors, with a particular focus on green transition solutions, makes her a valuable asset to our panel. She has played a pivotal role in numerous renewable energy and residential green transition projects, including OX2, Svea Solar, and ARIA. Her expertise will provide a solid foundation for our discussion on risk transfer solutions. Stephan Lesser, at the very end, a skilled professional with 7 years of experience, is a senior underwriter for Munich Re, Emerging Green Tech Solutions team. He is product lead for technology performance guarantee insurance, covering projects in the bioenergy and circular economy space, including carbon capture, hydrogen, and power-to-X technologies. Next, we have Kobi Weinberg, the Senior Manager of Strategic Initiatives at CREO. His unique role at this think to do tank involves mobilizing $1 trillion US dollars in private capital for climate and sustainability solutions. His previous experience at Nephilia Climate, a climate risk hedge fund, has equipped him with the skills to develop and underwrite financial risk transfer products for large sustainable projects. His insights, directly relevant to your work in the climate and sustainability industry, are available to our discussion. Kobi has been the managing editor for the Climate Tech VC newsletter for the past 4 years. Let me introduce now Tyler Christie, the managing director for the Decarbonization Partner, with over 20 years of experience as an investor, entrepreneur, data scientist, and growth executive in climate. He brings a wealth of knowledge underpinned by an MBA from the Wharton School. His role in managing a $40 billion US dollar assets under management venture growth equity fund for BlackRock and Temasek joint venture further underscores his expertise in this field. He now lives in London with his wife and 3 kids, where he tries to get outdoors as often as possible. He is the only one that has a family and leaves. The other one are only dedicated to their jobs. So, I let you wonder with this word, insurance. Well, Kobi and Stephan, this panel discussion is not just another talk. It's a unique opportunity for all of us to explore the world of risk transfer solutions. It's a term that many in the audience may need to become more familiar with, but it's absolutely crucial for the success of emerging climate infrastructure projects. So, let's dive in. What exactly are risk transfer solutions, and why are they essential for emerging climate infrastructure projects? The floor is yours.
Yeah, I can start off with answering that question. So Risk transfer solutions is basically an umbrella word for two different varieties of financial products. So you have insurance products, which are typically related to individual loss events. So that can be from a catastrophe or some sort of quantifiable event that's pretty easy to be able to understand. And then you also have derivative products, or usually hedge agreements, which are basically trying to protect against some sort of downside for a project. So those are usually more index-based and based on some sort of data feed, whether that can be about electricity price or something along those lines. And each one of these is used as a risk management tool when you're building bigger projects. So you might have a wind farm that's worried about its electricity price, and so they'll buy a hedge for some of that. Or you might have this wind farm that's also being built, and they're worried that the construction won't go toward plan and might actually cause some sort of loss, and so they'll buy an insurance product for something like that. So those are really the two varieties of risk transfer solutions. I'd say increasingly this is getting to be an interesting topic for entrepreneurs who are trying to build first of their kind projects, or going to build anything sort of in that realm, because when you talk about moving from equity to debt, equity investors are sort of willing to take greater risk than debt investors, and debt investors want some sort of protection against various risks. And so more and more people are going to insurance providers and to banks to get some of these.
So what we see is that the lenders, investors in general are very risk averse in respect of technology risks. So that means they are very hesitant to invest in something which is first of a kind, which is not proven. And this is where the insurance industry, where we can step in and take this risk and improve the financing of these projects. So improve the bankability of these projects. This is not a standard insurance product. This is really something which is new. The problem we see is it's not only that the technology is new, but also the technology providers are new in this business field. So even, how should I say, technologies which are around since 100 years, let's say, for instance, electrolyzers, fuel cells. The technology is known since a long time, but still the way they are applied today, this is something new. And they're combined most probably with other technologies. So there is an integration risk. And investors, lenders, banks, they shy away from this. They have not seen this. This is something new for them. The feedstock is new, the product is new, the whole technology is new, and they just don't want to invest in this. They don't want they cannot price it. This is a very serious problem nowadays, and that's also a problem why the energy transition is not really moving forward very quickly. So because all these issues are on the financing side, there are obstacles just slow down the whole process. And here is the insurance industry can improve the situation and enhance the bankability of these projects.
So now that Kobi and Stephan have illustrated us with we have a better understanding of what risk transfer is. Tyler and Matilda, you invest in many climate companies that must build infrastructure scale projects to succeed. What are some of the risks facing your climate portfolio companies? And have this risk made it difficult to raise debt capital? Please go ahead.
So I represent Altor Equity Partners, and we're a private equity fund, right? So, and I think all investors are kind of in the business of risk reward. So, but I completely agree that, there are different types of risks that different players in the space want to take. And for sure, we as an investor try to bucket those risks into certain categories. And I think, as you mentioned, Stephan, so technology risk is something that we're not as comfortable with. So on our end, we try to not take the types of technology risks, but kind of invest into technologies that we know will work. But we can do kind of pre-revenue investments. So the commercial risk is something that, to a certain extent we can take, but we need to see that there's a de-risking components such as offtake agreements. So kind of sometime in the future, we know that when the product is ready, when the technology is ripe, we know that the commercial demand is going to be there. And that is, call it, how we also de-risk on the financial side. So when we then, in those cases that we need to, so for instance, large industrial scale-ups such as H2 Green Steel that are building a green steel mill in northern Sweden, for those types of investments, obviously we need more capital than what the private equity scene could maybe put up in that instance, so debt financing. And to make it bankable, it's definitely the commercial de-risking, also from our perspective, that's very important. Then what we like to take is, maybe needless to say, but execution risk, where we feel like we can really support our portfolio companies in execution.
I second that. I would say you said it better than I would, but very much the similar position. I mean, we're probably investing a little bit earlier than Altor, so we do take technology risks, not novel technology risks, but many of our portfolio companies are really building their first-of-a-kind commercial plant. They'll have a pilot facility operating, but this is a scale-up. We view that as engineering technology risk rather than sort of science risk, that we like to parse that somewhat. But I think at this stage for a Series C company, there's not really a lot of alternatives for getting around that risk. It's really coming out of equity. So hence we raised a $700 million round for Ascend, one of our portfolio companies building a battery recycling plant, and that's all equity. Now, I think there's a plan there, of course, to de-risk that capital in the next stages of the company. But really, when we look at my colleagues in the infrastructure across BlackRock, those companies are much more mature and they have all of these products working, so we can see kind of line of sight to get there. But you need the first commercial facility operating to bring in insurance firms or other hedging products at this stage from what we typically see. So.
I think the challenge is really nowadays, so on the one side you have the technology risk, so whether the technology or the technologies are really working, whether the integration works. But then the other thing is also, if you look at, for instance, PV industry. So we are in this business since almost 15 years now. The problem is simply many of the manufacturers, many of the technology providers, they actually did not survive this phase. So that means for the investors, for the banks, the question is how much worth is a guarantee provided by the manufacturers? So they're just not existing anymore. On the PV side, we see this on the wind side, and it's also now with all the hydrogen industry coming up, so electrolyzers, fuel cells, etc. So everybody is really concerned whether these companies who are providing nowadays the technology and some kind of guarantees, whether they will exist in the future, whether they can step in case something happens, whether they can do the maintenance, the repairs, and all this in the future and guarantee actually the repayment of the debt obligations. And this is exactly where we as an insurance industry can step in and take this risk from the investor, from the developer to the insurance industry. So it's not only about the technology risk itself, it's also about the guarantees involved in all this interesting and necessary technologies which are coming up at the moment.
And sorry, and Stephan, what kind of data do you need to build all this kind of insurance?
So we are the insurance industry. We are employing many experts on the technology side. So we are relying traditionally on data from the past, but we also we have experts in our business which really look into the technology which is coming up. So, of course, this is uncertainty, certainly, on the one side, on the technology side, on the other side, on the economic side. Basically, we look what's existing, so data which is existing, so technology data. But what we are also focusing on is really the economics. So that means we are looking what are the future expectations of these technologies, of these projects, so income streams, etc. So on one side, technology data, but on the other side also on the economics.
Okay, so you also use the economical data to price all your models.
Yes.
Okay.
Yes. So it's very much about knowing the balance sheets of the individual companies and the whole economic environment. Yeah.
Okay, great. Thank you. So, Kobi, you work in climate insurance. Do you find enough climate-focused risk capacity and innovative products for the projects?
The short answer to that is no. There's probably not enough risk capacity today to actually underwrite all the technologies and projects that are trying to go out and raise. We're lucky to have places like Munich Re and Swiss Re and some of these other big, large reinsurance companies that have significant balance sheet that they can use to underwrite some of these bigger projects. But I'd say that it's still a pretty constrained market. So there still needs to be more capital that goes into risk. I think that there's a lot of capital focus on equity and a lot of capital focus on debt, but some of those places in the middle where about like risk transfer solutions or EPC contracts, so people who are willing to do engineering, procurement, and construction for projects, there's not as much money focused on climate. So you really have a lot of these incumbent players who have some carve-out strategies, but not as many people who are focused on just doing this for climate projects. So there's actually a very big opportunity, I would say, for stepping in to do some of those roles with emerging climate technologies. And when I was working at Nephila, we saw this go very well. So in the early 2000s, when wind projects were trying to go to banks to get loans, the banks said to them, we understand all of this risk. We understand sort of the price risk. We understand the construction risk. But how do we know the wind is going to blow for the next 30 years? And it sounds like a silly question, but if you're a bank, you want to make sure that the revenue projections are actually meeting what you're using to underwrite that project. And so what we did as Nephila is we had sort of stepped in with a product to underwrite revenue. So let's say the wind farm was trying to make 25 million a year in revenue. We'd say, okay, like we sort of get those projections. We think it looks like it's going to make more of 20 million a year in revenue. And we created a swap transaction. So anything below that, we would pay out, and anything above that, we share in the upside with the project. So we're also sort of betting on its success too. There just isn't as much money focused on taking that type of risk and also focused on creating those new products. And we just need more expertise and we need more capital coming in. So there's a human and a financial capital sort of gap that exists within the risk transfer market.
Okay, nice to know. I mean, I'm coming from a bank, and there are a lot of people just here. My colleagues are sitting here from the bank, so they're happy to know that there are these kind of things, so that next time that we just finance a project, then we have these possibilities. But Tyler and Matilda, are insurance and derivatives financial mechanisms that you or your portfolio companies have considered when building projects? And if yes, for what risks?
Yeah, well, I'll keep it short. I mean, we've definitely explored a lot of this, and we have we have 7 portfolio companies right now. Some of them building large facilities. I think most of what we see is really feasible in the market today, because I think I agree with Kobi, there's not enough of this, is essentially solutions around supply chain risk. So, de-risking the volatility or the inflation of some of the inputs into these products, especially for commodity producers. And so ways in which they can, look to mitigate that. Often it's more so just in structured contracts rather than insurance, but looking into other, hedging products or solutions there is something we've definitely explored, but I think it's relatively early days. And again, that's these are in more novel technology areas, like Monolith, which is making carbon black. It's not an established industry of how they're doing it. Now, carbon black's a very large, large market, so I think that will come. But as you said, it's getting people around the table more and more, and getting other capital to support that. In Monolith's case, it's going to be more of a government-backed debt. They have from the DOE loan program, a very significant loan coming in there. So, that will help de-risk the whole capital of the business, then enable some of these other products, I think, to come and sort of crowd in other parts of risk. So again, there, I think you see the government helping by stepping in some of these cases, if you will. But that's sort of what we see.
So we have approximately 50 portfolio companies, and I think they are all, in very different sectors. So everything from technology to industrials. And obviously, like the insurance coverage that you might need in those companies differ a lot, depending. So you need to really tailor it based on the business model and the company. But what we do is that in every instance, we actually do an insurance DD in conjunction with, call it, or before investing, so that we at least know what the coverage is, and so that we can make sure to cover the gaps. And we kind of do that as with, looking at value creation, in other ways. So we put up a plan, and we kind of then contact you guys maybe, or someone else to support us in making sure that the risk profile matches what we are willing to invest in.
Okay.
The advantage on our side is, so we are familiar with all of these industries since hundreds of years, more or less. So that means we are technology agnostic, so we can actually deal with any type of exposure, and so we are used to this. And normally, so it's no problem to adjust our offerings based on the requirements on the industry, on the society, and we are happy actually to offer to almost everybody an insurance solution.
So, Stephan, how do you see the future according to policies, technologies, specific products?
So what we see is the impact of the regulatory environment is certainly a very important factor. So government policies on a national and international from a perspective, this is very important. So we see that the whole train is somehow moving forward at a much faster pace at the moment. So there are more projects in the pipeline now. I think everybody's a little bit aware that this is really pressing. So we see more business opportunities. We see more support from the governments, and so we are open actually to react to this and also adjust our offerings according to these upcoming opportunities. So this is really something which is very, from my point of view, very positive at the moment.
Okay, great. And last question to you, Kobi. What can entrepreneurs do to help with new product development? You said you didn't see enough in the market, so now the long answer, please.
Yeah. So one of the things, a lot of early stage companies will typically come to me to try to at least have that conversation a little bit about risk transfer solutions and about insurance and sort of hedge products. And one of the things that I always tell them is from day one, whatever the risk is that you're probably most worried about, start collecting projected versus actual data for whatever that risk is. So if you're building a project and you're expecting some sort of output, a lot of people want some sort of technology performance insurance or something, which Stephan has some experience with, but just start looking at like, okay, we think that we're gonna make 100 tons, but in reality we made 95. And if you can predictably start to hone that model a little bit, you can show to underwriters and banks that you actually know what you're doing. And so it can help to create some of these newer products. And the longer the data feed that you have to do that, the easier it is for a lot of underwriters to actually price that risk and to see how reliable some of your models are or your project is in producing that output. So that's usually what I tell people to start doing, is just as early as possible for whatever those risks are, whether it's construction risk, how long it takes you to do this, or the financing that is required to build some of these projects, or how much output you think you're going to produce, and sort of at what time scale. Try to collect as much data as possible and try to predict what you actually think it's going to be, and then see what it actually is.
Okay, great.
Yeah.
Thank you.
Yeah.
So for the public, just one word or sentence from every one of you to insurance. So what would you say if you had to say one thing? We have 30 seconds, please, one word.
If you have a problem, just come to us.
Okay.
Maybe I'll leave it at that then. But I think just some of you are very early stage, and kind of you will grow into call it all of this. The very short answer is already over. But so I think all the investors are kind of in the business of risk reward, and we will consider the profile, and we will support you to get to a place where that works for us.
Yes.
I think projects want to move as quickly as possible, but it's really important to consider risk management when doing this, so that you can create returns for your investors and be able to do that in a profitable and replicable way.
Okay.
And yeah, I'd just say, obviously, it's complicated and it takes a lot of time, so your biggest risk is to run out of capital. So raise enough capital to have the time to figure it out, and optimize, and then start working early to optimize that. I think the biggest risk is companies don't raise enough capital, and then they run up against the wall trying to figure out these solutions, and they're not quite there. And then you get into a down round or very difficult position. So and nobody wants that. Certainly not your investors. So.
Okay, thank you very much. So public, the panelists have given a lot to you, so please a big applause to the panelists.
Thank you.
Thank you.
Thank you very much.
Thank you.
Thank you.